This is Doug Gerlach from iClubcentral and myiclub.com. Welcome to our Investment Club webinar for May 20th, 2025. We're glad you could join us tonight. We're going to take a look tonight at the topic of disbanding your club, but also what to do before you decide to disband, if maybe there's some things that you could adjust about your operations to help keep your club going strong. If you're feeling like members might be wondering if the club should continue, maybe there's some adjustments you could make. But if you do come to that decision, the process of disbanding is something that every club will have to deal with at one point or another, more likely than not. And it's not something that you will have, your treasurers and administrators will have experienced before. So there are a lot of things that are unique to that process. And so we like to cover that in this particular session. And so we don't expect you to recall all of this, but we do have help documents, and you'll be able to review this webinar video in our YouTube channel video library. So at some point down the road, when the club is talking about disbanding, you'll remember that, oh, wasn't there a webinar on that? And you'll be able to look it up and get all the details and refresh your memory. So that's our intention tonight. Joining me is Russell Malley, our club accounting advisor, and Sean Pulrang, who's our senior support representative. Treva Dildine is also on the line in the back office. They'll be answering questions there if you have them, and we'll be taking breaks throughout the presentation to address questions about the content. There is a handout for tonight's presentation that you can grab in the GoToWebinar application. So download that PDF for future reference. And if you do have questions, feel free to type them in to that questions box. So in our session tonight, we're going to try to provide a little bit of help if you need it to continue your club's operations. We'll also provide some tips for winding down your club, discuss some of the strategies for paying off members, review the all-important tax considerations that come with disbanding and dissolving a partnership, and talk about our newest product for protecting your club data down the road if you should need access after your club has disbanded. So we've been doing a lot of work post-tax season with my iClub and bringing in some additional improvements that we'll be talking about in the coming months. So let's talk about some of my favorite tips for keeping investment clubs going strong. After all, there's nothing that says that your club has to disband or can only last for a certain number of years. In fact, today I was contacted by someone, or read a message on our club forum from someone who's been in an investment club that was started in 1957, and they're still going strong. We have many clubs that are 40, 50 years old in better investing and using my iClub. So the investment club framework is something that doesn't have an expiration date. It can go on and on and on. But part of that is making sure that you're operating smoothly, that you're not creating excessive work for your treasurer and administrator, and that everyone's on board. One of the things that we see most commonly when clubs talk about disbanding is that the treasurer is burnt out and no one wants to step up to take on the responsibilities. This is the biggest factor that we see in the dissolution and termination of investment clubs. And for many years, I've been preaching a sermon on keeping the treasurer's job easy. Keep things simple, keep things straightforward. Don't make things excessively complicated. Don't require your treasurer to be the police officer who's collecting dues and payments and late fees. Don't invest in securities that require lots of extra work by the treasurer at tax time or on a month-to-month basis. Don't try to invent new rules about how to run your investment club. Follow the tried and true principles, and you will have a better chance of success. My iClub has really evolved over the last 20 plus years to be more than just a tool for accounting and record keeping, but also to support club operations and portfolio management. And we're really trying to keep things as straightforward and simple as possible so that you've got all the tools you need in one place to manage your investment club. In the file storage area in my iClub, there are a number of quick start guides and manuals that we'll point you to that will help you if you're having questions, if you think that you are there are improvements that could be made and you want some ideas. So check those out as well as our massive library of videos that you'll find on our YouTube channel. One of the things, let's just start with talking about some of the principles of keeping the accounting simple. Unit value accounting that's used in investing partnerships and for investment clubs is complicated enough. You don't need to make it especially complicated. And one of my tips is to not use dividend reinvestment, automatic dividend reinvestment. Better Investing says that you should reinvest all your earnings, all your income, but that doesn't say invest all of your earnings in the securities that earn them for you. It's merely saying don't spend your profits. That's probably a better way of looking at that adage that Better Investing teaches, one of its 4 key principles. And dividend and reinvestment adds complexity. Again, 20 years ago, this was not nearly the case, but with changes to the tax code since then that affect partnership accounting, it makes it even more problematic. One of the problems comes when you sell those shares that have been purchased by reinvesting dividends. Now you have to reconcile all of those tax lots. And if you've got a quarterly dividend that's paying 4 dividends a year, that's 4 tax lots a year. You do that for 10 years, and now all of a sudden you have 40 plus tax lots that all have to be reconciled when you sell the securities, and some of them may predate the IRS rules. If you're a longstanding club, the rules regarding brokerage reporting a basis to the IRS, and so it becomes kind of a more difficult task at tax time. And so another problem comes with the reclassification of dividends that happens with many securities and many non-stock securities that cause you to have to edit transactions, and we've got dividend reinvestments there to change the disposition of those. Distributions can be problematic, and we often see a problem when securities are sold at a loss. There's dividend reinvestment that's been turned on or is ongoing in the portfolio, and it's not turned off, and so a dividend comes in and it's reinvested, and now you have made a purchase after you've sold that same security at a loss, and now you have a wash sale that has to be adjusted, and that can, again, provide headaches. For a few dollars, perhaps, of a security purchase, now you're going to have to disallow some of the loss and make adjustments. So it really makes things more complicated. We'd much rather you just take your distributions, your dividends, add them to your available cash, and invest in the next great opportunity that comes along. If you want to use dividend reinvestment in your personal account, you don't have those same issues, many of those same issues that you have that comes with partnership accounting. And so I think that's an important distinction to make, and don't confuse what's good for your personal portfolio may not be good for a stock portfolio in an investment club. We also don't see the need for late fees. A lot of clubs like to enforce behavior by charging fees, late fees, and for missing payments. And again, this is unnecessary in my view. If you have members who aren't making their payments or aren't paying on time, they're really only going to hurt themselves. They're missing out on the opportunity to see their capital invested and to grow, which is the whole point of your club. So penalizing them may be a great source of income for the rest of the members, but that's not really the objective of your club. And so the levying of fees and the collection of them, falls to the treasurer, who now has to remind people, oh, you were late with your payment. Now you've got to pay an extra $5 or we'll take it out. This is just an excessive complication. You don't need it. If you keep things simple and you treat your members like adults and grown-ups, everyone can live harmoniously and in a reasonable fashion over time. With my iClub now, there's no need to print valuation statements and member status reports and other reports and bring them to your physical meetings or to email them to members in advance. They can all go to the website. All your club members can go to your My iClub club website and they can download the reports they want for any period at any time. And if you want, your treasurer can send a nice message that says, don't forget to grab your copy of the valuation statement prior to the next meeting. That's great. We've got an email function built in that will send that alert for you. But otherwise, again, just more wear and tear on your printer, who's going to pay for the toner and the paper and the time that it takes the treasurer to make those printouts and bring them. And so save a tree, go electronic, and let your members, if they want to print it out, they can do it themselves from the website. Avoid problem securities. We talk a lot, especially at tax time, about certain types of securities that are problems, provide tax snafus for your federal and state tax returns, or require excessive adjustment of data in the books that just aren't suitable for an investment club. And these include exchange traded funds or mutual funds. Again, they're paying distributions. They may have those distributions may not be dividends. They may have other categories of income or returns of capital that have to be adjusted after year end. There are slightly different rules for selling them as compared to selling stocks. Real estate investment trusts can be great for diversification purposes, but their distributions, if they're paid monthly or quarterly, are reclassified at the end of the tax year. So again, more work for the treasurer. It delays the preparation of your tax returns in many cases. Master limited partnerships and royalty trusts, again, require lots of adjustments because of the nature of those investments. All sorts of commodities and precious metals also create problems with especially your tax returns because they're not stocks. They're not treated the same way. And that goes for ETFs that own commodities directly. So you know, someone in your club may think, oh, it's a great time to buy gold as a hedge. And so you find that gold ETF and you buy it. And then you learn that gold is taxed as a collectible, even if it's in an ETF, not as an investment. And so now you can't use the My iClub Club tax program, and you've got a whole other set of headaches. So, you know, we can go into details, but the bottom line is stocks are great. Stocks work well. Other types of securities can create problems for your treasurers. Now, some treasurers love having the challenge of additional work and additional resources and having to do the research and making adjustments to the club's books. And yeah, that's great. So we're not saying never do it. Everyone should avoid it. But if you don't understand the ramifications, you should definitely stay away from those types of securities. Simplify and reduce your expenses. We hear a lot of anguish from clubs about your Better Investing member dues. Better Investing is our parent organization, a great nonprofit that supports investor education. We believe that everybody should be a member of Better Investing within an investment club so that you share that common outlook and have the similar tools that you can use, and everyone shares an investment objective of identifying growth stocks. But you know, again, your club gets to decide. Maybe some members don't want to be Better Investing members, and again, that's great as well. My perspective is that club expense should benefit everyone, and even if some members don't want to be members, well, then everyone is still paying for the club should still pay for everyone who wants to be a member and share that expense according to how you share other income and expenses within your club. Some people can't get over I'm paying for somebody, my share of this expense is more than somebody else's. And so, yeah, I get more of the profits because I own more of the club portfolio, the club's assets, but they're not willing to make that expense. So again, can't convince people to see it another way. And if that's the case, don't keep it on the books, just keep it off the books. Better Investing will let you collect checks from those members who do wish to be members of Better Investing, and you can send them all in with your membership form. And that's fine. So you can easily simplify things. There shouldn't be a whole lot of other expenses that your club is undertaking besides the cost of tax preparation and your accounting tools. But again, the more that you can do to simplify the number of transactions and kinds of transactions, the better off you'll be. Another case is what happens. We see a lot of clubs who see the instances of a stock merger or acquisition, especially if it's a stock that you own is bought by another company, and instead of cash, you get cash purely, you get cash plus shares of another company. And so now you've got to go through the corporate actions transactions, the merger acquisition screens. You've got a parent company and a child company, and how much the basis is applied to the child company that you receive from the parent that you owned, and the IRS says, yeah, there are lots of different ways that you can calculate it, and so your broker does it one way and the company does it another way in their documents. And so clubs go round and round trying to figure this out. They feel like they got something, they got a deal, they got free shares perhaps, but really that's not the case. And so my rule of thumb is and it's very rare that I'll see the case of a merger or a spinoff or an acquisition where I want to hold on to that company that was spun off. It's a small position. It's a lot of times when companies make spin-offs, they spin off a package of all of the debt and liabilities and assets that aren't perhaps the most interesting into that spin-off business to kind of get rid of them and clean up the parent company's balance sheet. Or the company that's making the acquisition is desperate, and so they're paying a premium for the company that you own, which is great for you, but they don't want to pay cash, so they're going to give you shares of the new parent company. Well, if you start looking at these transactions, you'll notice that as soon as they get announced, and as soon as there's a value attached to them, even if it's tentative, the price that you will receive in those types of situations for the shares that you do own, whether it's in cash or stock of an acquiring company, is not going to be materially different from waiting for 3 months for the deal to finalize and for you to get the final payout. There's a limit, because there's a limit to the upside. Everyone knows that if you hold it for the stock for 60 days until the deal closes, this is how much you'll earn. And your capital is probably better deployed by getting rid of that security and purchasing another one. So that's my rule of thumb is, you're holding a company. It's been announced that it's going to be acquired, yeah, there's no guarantees until the board approves it, but my rule of thumb is go ahead and get rid of that company now. Take the money, take the cash. If it doesn't happen, the stock price of your company that you did own will go back, and you can repurchase it if you want, if the deal falls through. So again, it saves you having to go through that complicated process of determining the basis and doing the research. And yeah, we provide all the help. We'll give you for the most popular mergers and acquisitions and spinoffs. We'll give you instructions, suggested instructions. Russell does a great job of doing the research for those, looking at the the SEC filings and looking at the company's press releases and doing the legwork so that you can enter them. But if you want to make it easy, enter one sell transaction and take the cash and move on to something else. So those are some of the things that you can do to keep the accounting a little simpler. Another thing to do, and probably the second reason that clubs don't stick together, is because they're dissatisfied with the performance of the portfolio. And I see portfolios all over the place in terms of what might be called a strategy, even though it might be not very delineated. I see people who are better investing members who are touting stocks that really don't fit the better investing model. And again, that's okay. It's okay to be a little speculative. It's okay to be a little, a little conservative and go for the blue chip for a portion of your portfolio. But at the end of the day, if you're not focused on long-term growth, and if the members are not in unity around that objective, then the club is not likely to perform very well, and that could lead to your dissolution. So don't own too many stocks, right? 20 to 25, 25 to 30 for a mature club is a great number to be diversified and to not provide too many potential accounting headaches for the treasurer. No stock should be less than 3%. If you're holding stocks at 1 or 2% of your portfolio, they're not contributing to your total return. If they double overnight, 100% gain, it's a 1% gain in your portfolio. If it was 1% of your holdings before the price jumped and now it's 2%, still not a contributor to your long-term success, really. And so I say divest those smaller holdings and be concentrated. Do reconcile your books monthly. We have the reconciliation wizard that we've built in to help you do that. It's just vitally important with unit value accounting that every transaction gets accounted for and is accurate, because even small errors will linger for years. It's not like you can, just do a write-off at the end of the year and everything will magically correct itself. Those small errors will compound, and we hear from clubs who a new treasurer comes in and says, well, there was a problem, I finally figured it out. It was this transaction back in 2017 that I think was not done right. That's a long time ago for this error to be writing in the books, and what it takes to go through hundreds and hundreds of transactions to find it is just an incredible task. So if you reconcile monthly, you're more likely to figure those out, and then every year audit the books. Keep the books clean at the end of the year, and make sure that the members are helping on the audit committee. They're understanding what's going on, and maybe they will start to see the benefits of keeping the portfolio in line and the books balanced. And again, that process of reconciliation and auditing the books is much easier if you don't have a lot of extraneous unnecessary transactions going on, like dividend reinvestments, like lots of late fees and other types of expenses and items. Make sure, of course, that you file your club taxes annually. There is nothing worse than figuring out that you missed a filing, you were late with a filing, dealing with the IRS, trying to get penalties abated. Nobody wants to do any of that. So stay on top of things at tax time and make sure that you're filing on time and accurate returns. History shows that clubs that are disciplined and that have a common approach earn the best returns. The clubs that are problematic often have some members who have a desire to use one particular approach to investing, and others who are trying to stick closer to the better investing approach, and some are disciples of Warren Buffett and want to be looking at value companies, and other people like to be a little more speculative. Those are all great. In your personal portfolio, you get to do whatever you want. In a club portfolio, the members need to join together and have a consistency of approach. Your long-term target should be to outperform the market. In the short term, one of the things that you come to realize is that there will be periods where your portfolio doesn't perform as well as the broader market because of what the market is interested in. What are the fads that are driving the market? What are the trends, and what's the economy doing? But over time, investment clubs using the better investing approach will see that their returns kind of outperform the market during downturns because of focus on quality companies. You're kind of holding on to stocks that have high quality attributes, and so those will hold up better during market downturns. And maybe they don't reach the excesses of the bull markets quite so much, but they will tend to outperform lower quality companies, and over longer term periods, you will see your rate of return be quite acceptable. The benchmark and performance report in my iClub, not something you have to look at every week. Once a year, twice a year, maybe it's good to kind of take a look at it and see what might be going wrong. And it's often it's pretty easy. You had one stock that didn't work out very well, and it was down 40%, and you sold it and say, well, that's going to impact your performance in the short term. But you redeploy that cash and you continue the process, and over time you'll see your performance come more in line with your objectives. Consistency is so important when you're investing, and especially in an investment club. A sort of scattershot approach where somebody says, well, I had this idea, and there's no stock selection guide that's done, there's no real research done. It's just an idea that, with all these new electric vehicles, isn't lithium going to be important? And so we're going to find a lithium mine operation to invest in. Perhaps, but it's much better to say, well, where are the values right now? Perhaps be a little more contrarian. Instead of trying to guess where the trends are, try to guess what the geopolitical situation is going to be like, and just focus on the basics of business, what makes a company good. And that's the better investing approach. If you're parking cash, again, not something that you need to worry about in an investment club. If you're trying to time the market, not something that works for clubs or individual investors. If you're overloaded on dividend or income stocks, you're probably giving up total return. Maybe you feel like your portfolio is safer, but over the long term, a safer portfolio that underperforms the broader market by a large margin is generally not desirable. So you've got to balance that risk with the opportunity for turn. And if you're investing outside of common stocks, I feel like your club portfolio should be a stock portfolio, and that will make it easy for your members to slot in. All right, my club asset is part of my stock portfolio. I've got a dividend portfolio over here, and I've got an income, some income opportunities over here that aren't stocks. That my broker recommended. Hey, that's great in your personal portfolio. But the minute that your club portfolio is 30% dividend stocks and 60% quality growth stocks and another 10% of random speculative ideas, makes it really hard for individuals to take that portfolio and slot it into their personal approach. Maybe your club's got some 60-year-olds, some 80-year-olds, and some 40-year-olds. They've all got different approaches to their personal finances and their personal portfolio. So you're having a good, strong stock portfolio is really a benefit to everyone. And if they want to cut back on their stock exposure in the club, they can withdraw some of their capital, or they can add to it if they're in that aggressive building phase, in their 40s and 50s, where they're really at the peak earning powers and they're putting money into the market and they're working towards their financial goals. So for that reason, I like to think of your club portfolio as an equity mutual fund. It's a private equity mutual fund. And just like with most mutual funds, they have an objective, and that objective is clear. And it might be by company size or style, and there are certainly balanced funds that have stocks and bonds and cash and different assets, but the purest model is just the stock, a multi-cap equity mutual fund or ETF, and you can emulate that model, and again, I think increase your chances for success. On the operations side, certainly in the last 20 years, as there have been more and more tools that facilitate online communications, and with the COVID pandemic, 5 years ago, and the changes since then, a lot of clubs have shifted their model from meeting in person to meeting online or some hybrid approach. And again, the traditional model of meeting once a month, bringing your paper checks to the meeting. The treasurer collects the checks, the club sits around for 2 hours, reviews the portfolio, makes decisions, makes buy-sell decisions, and then convenes the meeting. Doesn't mean that has to work here in 2025. That doesn't have to be the way that it is. And I certainly have know of many clubs that have been together for 30 years, and they've got a $2 million portfolio, and they don't see the need to meet every month. They meet every quarter, and they meet online, and once a year they get together and they have a big meeting and a dinner and do their business, and the rest of the time they are meeting using an online model. So find what works for your particular club. If you're running into obstacles or people are finding it difficult to come to meetings, and see what can work for you. Another idea is that for your stock research and your portfolio management, it doesn't have to be done by everyone at every meeting. I'm a big fan of committees and delegating, and letting certain members take on certain responsibilities. So you've got a portfolio committee, you've got a stock research committee perhaps, and you let them take the lead in doing the research, and it can be a rotating committee, that's great, but successful clubs will find the structure helps them, as opposed to clubs that say, well, does anybody have any stock ideas this month? Again, there's no direction, there's no focus, there's no demand for anyone to really kind of contribute in a meaningful, structured way. And so that's something that you can do. You can work towards having a little bit more structure. It doesn't mean that every meeting has to be a reiteration of you didn't do your homework, did you? But giving people the opportunity to step forward and say, all right, why don't you take on this role for the coming year, and try to be the portfolio management guru for the club and lead us down that pathway. So for more help, our YouTube channel, we've got a whole wealth of archived webinars there that you can find. The Better Investing and My iClub Investment Club forum lets you connect with other club members, and that can be a good resource. You'll find it linked from the My iClub homepage. It's also available from the Better Investing site. The club forum is available to anyone who is a My iClub user or a Better Investing member. And so feel free to drop in there with questions if you have, ask for advice. And you can always reach out to our support team for questions. You can call or put in a ticket with your questions and comments, and the team does a great job of responding to all of those. So feel free to use the questions box, but we're going to go in now to the discussing how to disband your investment club. I call this if all else fails. Here's what you're looking to do. And there's a lot of detail here because we wanted to cover the bases and trying to make sure that everyone had a resource. So I will kind of run through this fairly quickly, but you can always refer back to the webinar, the recorded video, if you need to. So any vote to disband your club should be conducted in accordance with your partnership agreement and/or your bylaws. That should say, that it should clearly state what are the conditions. Does it have to be unanimous? Does it have to be a 3/4 or a 2/3 vote in favor of disbanding or dissolving? Follow that rule. You don't want to fake it at a meeting and vote to disband when there wasn't a quorum, and that puts you at some legal jeopardy perhaps. So do follow your club's partnership agreement. If it doesn't, refer back to the Better Investing or My iClub sample partnership agreement and see if you need to modify your partnership agreement. Do that now. Don't wait until you want to disband, and now you got to figure out how to decide to disband and then put that in, vote that in and then vote to, right? It gets very complicated very quickly. Also, we want to just remind you there are a lot of local, state, federal reporting and tax requirements that you'll need to adjust. And we've got an FAQ, frequently asked questions. Number 50 has complete instructions. You'll find it on the club FAQ page at My iClub, and it will have all the details of things you need to know. Choosing your closing date is important because we get a lot of calls in November where people say, oh, we've decided the club has voted to disband and we want to do it before the end of the year. Well, that can be problematic. You can certainly dissolve at any time. However, sometimes it takes more than a couple of weeks to wrap things up. It can take some time for the broker to effect stock transfers. It can take time to get checks cashed. It can take time to go do the legwork to figure out how exactly you're going to pay out the members with their final withdrawals, whether it's cash or stock or some mix of the two. And so it can be problematic at that point. And there are also some glitches we'll talk about with the IRS. And they have kind of a weird rule about which year's forms you can use to disband. The IRS does state that the deadline for filing a final partnership return is the 15th day of the third month following the date the operation ceased. All right, and so just like March 15th is the deadline for your annual Form 65 partnership return, if you disband in June, then the third month after that, July, August, September 15th is your filing deadline. If you disband in June, you do not wait until the following year to file your final return. Otherwise, it could be deemed late, and late filings can be penalized. And that's a significant penalty per partner per month that the return is deemed late. So as I mentioned, there are some glitches. If you are disbanding after September or October, the IRS says that you have to use the next year's forms. You can't use the current year's forms if those next year forms have been finalized by the IRS. But the thing is that no tax preparer will have e-filings available using the next year forms for that short year return that's due in the current tax year, right? So and there's a window there where the 15th day of the third month may fall before the end of the year, and you would be liable for preparing your return by hand. You wouldn't be able to use the MyClub Club tax to prepare the return. So it's a little bit of a glitch. You have a couple of options. You can request an extension, right? You can request an extension. We've got a Form 700 form for IRS Form 7004, which is the request for an automatic extension of 3 months. So you can certainly file that, and that will give you 3 months after that 15th day of the third month. Another option is to just postpone your filing, your closing date a little bit by keeping things active so that you're in that window. So just keep that in mind. That's a little weird glitch. The IRS typically approves forms in September or October. Often the partnership returns might not be approved until a little bit later. But if those paper forms are available, the IRS says you have to use them. And that's kind of a tedious process. You're now not looking at not just using the MyClub Club tax, but having to figure it out on hand. And that, I mean, I wouldn't want to do a club's tax returns by hand. And so I'm sure that you wouldn't want to do it either. So if the ideal date, as Eve asks, would be, anytime after, say, August, you've gotta watch out. So um, um, August, September, October, those are the dates where the 15th day of the third month after that could be in that weird kind of window. But you can reach out to us. We can give you an update on the status, and we have a new final club tax module application, and so we're going to be monitoring this a little bit more this year and kind of figure it all out, and we may be able to convey that information on the in the club tax store or in our FAQ. Another issue that comes is the dividends, especially if you got the reinvested dividends, but it could be cash dividends. You close the club, and then you've written the checks and you've transferred the securities, and this brokerage firm says the account is zero, but you have a dividend that's received and comes in, and so now you've got cash. What are you going to do with it? It's very takes you've got to put a little post-it note, right, and remind yourself, look at the dividend schedule, and make sure that if you're selling a security, before after the X date, so that you're going to receive that dividend payment, you just want to make sure that you're aware of that, and you might want to postpone by a week or two your closing date so that you can get the cash from that distribution and add it to the mix. Sell the securities, but don't write all the checks all at once. Another tip is that often the treasurer is the last to withdraw, and that's because you can capture any of those final small income items that might come in, and they just get added to the treasurer's payout as sort of a treasurer's bonus, and most members are fine with that little, giving up the $15 or $30 or whatever the dividend is to the treasurer for doing that, the additional work to disband the club. Turn off the dividend reinvestment. Again, as soon as you start thinking about disbanding, make that vote. You should be turning off dividend reinvestment in your brokerage account, because it's much easier to deal with the cash than the fractional shares that now you've got to sell. Now there's additional tax lot, right? You don't have to deal with any of that mess. If you another approach, if you know that the dividend is coming in, you can account for it, right? You can enter that transaction in your books even though the cash isn't there yet, and then process the withdrawal. Just make sure that nobody cashes the checks until you've got the cash in the books, right? But again, the treasurer can do that in his or her personal club account, and they would know that I can't cash this check until that last dividend hits the broker, and then I can cash my personal payout. Any sort of automatic transactions that are coming in or out of your account, if you're, maybe you've got it set up so that you sweep money from your bank to your brokerage account, right? Or any type of automated expense payments, you want to turn those off again as soon as possible. And very important, remind your members to turn off any automatic member payments that they're making, any electronic transfers. They might be making their monthly member payments right into the club's bank or brokerage account. Make sure that they turn those off, because again, how are you going to handle another $50 that comes in after the club is disbanded because someone didn't turn off their member payment, right? So in those cases, often it's better to just, it may be possible to cancel it or return it, but if you've got a checkbook, just to refund those monies to the member who messed up. But again, if you can avoid that type of issue, it'll just make things go a little bit more smoothly. Also keep track of pending expenses. We'll go over some of these costs a little bit later, but if you need that My iClub renewal, because it's going to expire before you're able to close down. If you got printing and mailing costs for your tax return, or if you're mailing checks to partners, you want to capture those. There is a final club tax, federal and final club tax state if you need it. There are separate modules for preparing your final returns for short year, final disbanded partnerships, and we have a new iClub data archive and protection plan that we'll talk about. If you need to, again, Treasurer can prepay these expenses. In other words, record them in the books so that all of the amounts are accurate, even though you haven't actually spent the money yet on those items, but that way you'll have a clear picture of how much cash is available to be divided amongst the members. You can also advance the money to the treasurer, who will take care of them personally. Again, it all kind of comes out in the wash, and as long as you document it, there's no problem with those types of approaches. So one of the biggest questions, it's a little fun, it's also a little challenge, is to figure out, how do you pay out your members, right? Do you give them stock? Do you give them cash? Do you sell securities? What are the benefits? What are the advantages? And so in terms of the accounting, every partner who is in the club at the end has to have a final withdrawal. And that final withdrawal is no different from the club. If the club was ongoing, they would still be making, club members would be withdrawing fully from the club. And so there would be a full withdrawal. So it's really no different. You're just going to be doing that process for all of the club members. And just like with a full withdrawal, members can receive cash or cash plus stock. And the thing to remember is that if you do choose to transfer securities, they have similar benefits to using securities to cash out a full withdrawal while the club is still in business. And so that can be an advantage. It does make things a little more complicated. Certainly, the easiest way to accomplish a club termination is paying all the members in cash, selling everything you own, collecting the cash. It's straightforward, it's easy, and that is, if there were no other considerations, that would be a great approach. If you've got a lot of capital gains that are unrealized, that are going to be realized by selling the securities, and you've got a lot of extra capital gains liability that the members are going to be have to worry about, well, then maybe you want to look at transferring securities. If you sell all your stocks, you're going to trigger capital gains and losses right away, and all your partners are going to be liable for their share of those in their next tax return. They're going to pass through just like if the club was ongoing. You can see those realized gains losses on their everyone's personal withdrawal reports for that final withdrawal. But the alternative is to transfer shares to members. It's more complicated, but the receiving members of transferred shares do get some tax benefits from it. It's not like they're going to not have to pay taxes, but they have more control over the taxes, that the timing of when taxes will be due, and the possibility of taking advantage of other opportunities to gift shares to a qualifying charity, for instance, that might have some additional tax benefits. So the thing to remember is, at the time of the payout, so the time that you're closing the club and transferring shares, members who have the same cost basis in the club will have the same gains and losses on paper, whether they take cash or shares of any security, an appreciated or a depreciated security that's gone up, security gone down, doesn't matter. At the time of the payout, the value of those gains and losses will be exactly the same, whether you take the cash or you take the stock. If you take the cash, the gains and losses are realized at the time of the member payout, right? So you decide to take the cash, so you're going to get a payout, and that payout's going to be detailed. It's going to say, here are your gains, here are your losses, here's your income, your expenses related since the last tax reporting period and for your investment in the club. If you're taking securities, the basis of those securities is going to be adjusted to reflect your cost basis in the club. So you're going to take that property, those shares, and then you're going to say, well, I like these securities. I'm just going to hold these stocks in my portfolio. You can hold them for 10 years and then sell them, and then you realize the capital gains and losses, it will be capital gains, we would hope, from your withdrawal from the club. So, in that 10-year period, if you decided to donate the shares, well, then the basis gets stepped up and you get the value of the securities on the date of the donation to your qualifying charity, and you didn't pay capital gains. You could gift the shares, you could leave them in your estate until you pass away, and then the basis gets stepped up and your heirs get those shares and can decide what to do with them. So the mechanism of transferring shares in a final withdrawal does not mean that if one member takes the stock that's down 40%, that they're not going to have any capital gains to worry about. Nope, that's not the way that works. And we wouldn't recommend transferring shares that are depreciated. But it also means that the members who are going to take your, NVIDIA or Apple stock that's up 700% for the club is going to be liable for all of those gains because they took that highly appreciated stock. That's not the case either, because the basis gets adjusted for their cost basis. So again, this is not anything that's any different really than a full withdrawal involving transfer of shares that happens during the course of your investment club operations. I will note that starting last year, or the current tax year, individuals, or I'm sorry, last year, the 2024, if you received property from a partnership, which includes investments, securities, you've got to file a new form with your personal return. It's IRS form 7217, just your report of property distributed by the partnership. And that's something new. It's not a very, it's paperwork. It's not especially complicated, and we'll give you the withdrawal report. Will give you all the details you need to report that property to the IRS that you received from the club. So if you're paying out cash and shares, if you've got stocks that are held at a loss, you're better off just selling them, right? Sell them, capture the capital loss. Those capital losses are going to get passed through to partners. It's going to reduce their personal capital gains, whether in the club or elsewhere. It's going to be, have an immediate benefit in the current tax year. If you have securities that nobody wants, yeah, get rid of them. Even if you have to generate capital gains, nobody wants the securities. Don't force them. Go ahead and get rid of them. And then what's left to determine if there are shares, if there's a stock that a member would like. You can have everyone list their stocks in preference. I'll take these stocks. Somebody may say it doesn't matter to me. I understand how withdrawals that include shares work in an investing partnership, so I don't care which stocks you give me because it's all the same at the end of the day. And if it's a dud, I'll sell it, and if it's a good stock, I'll just hold on to it. And so that works out just fine. So just keep in mind that the club's unrealized gain or loss in any security is irrelevant to the member receiving those shares. The basis of the shares gets adjusted, and so you shouldn't let anyone go, well, I don't want that particular company because it hasn't gone up as much as some of the others. Yeah, I can understand. If you're looking at the company from the perspective of an investor, you might say, well, some of the stocks look better on the SSG than others, and I want one that looks better on the SSG right now. But that might be a stock that's a little overvalued, right? So you've got to make those decisions. But That's part of the fun of the withdrawals, figuring out how it works, how it might, how you can successfully do it. The withdrawal scenario calculator can help you as you go through this. You can kind of just double check what it tells you are great stocks to transfer, what are great stocks to not transfer, to sell, what would generate capital losses. And you can revisit that tool just for, one or two of the members and just kind of see as step through it. We're working on a similar kind of tool for disbanding your club that will help with this decision process as well. In determining which shares to transfer, method one, which gets used, and I find it kind of unfathomable that anybody would choose to do this, but they wanted to be fair, so they decided they would give every member a percentage of every stock in the portfolio. That meant that the treasurer in a 15-member club, they own 15 securities, and so every member got a share of each of those 15 securities, and that meant that the treasurer had to make 225 separate transfers at the brokerage firm to transfer, a couple of shares of each of the 15 securities to each member. That to me seems really complicated. Yes, it's fair, but is it sensible? Probably not. I think the better opportunity is to have your members select the securities they want, sell the shares nobody wants, have the members rank their choices. If nobody else wants a security, hey, it goes to the member who said, yeah, I'll take that stock. And then you might have to do a lottery or negotiation or discussion. But if everyone understands that it doesn't matter, the past performance of the stock doesn't matter in terms of the value of and the liability of taxes, just look at it from an SSG perspective. What are the best bargains right now? Good companies at good prices. That's what I would choose. And if your club is smart, maybe you've got a little bit of a bidding war that will go on for those particular companies. But you're gonna have to figure that part of it out. Now, another wrinkle comes from transferring shares at brokers. More and more brokers are not allowing transfers of shares from the brokerage account to an external brokerage account to an account that's not under the same name as the investment club, which means, if you are using, E-Trade for your club account and you want to transfer to a member's Vanguard account, E-Trade probably will go, no, we'll transfer to your club account at Vanguard, but we're not transferring those securities to an individual at that Vanguard account, right? And so they'll say, E-Trade will say, if you want to transfer shares, we'll do it to any customer at E-Trade, just have them open an E-Trade account, right? And those are just examples. It could be, every broker is different. I don't know the rules about E-Trade and Vanguard transfers. I do know that at brokers like Schwab will not allow external transfers to accounts that aren't titled the same as the club account at Schwab. But the workaround is pretty straightforward. You just have each member fill out an application form and open a Schwab account or a Fidelity account or whatever the same broker that the club uses. And then you can do those security transfers. Brokers may charge fees for transferring. Those should be borne by receiving partners. If all the members are receiving shares and no cash only payouts, that's a club expense really, and so you can enter, once you know what that expense is, you can enter it before you write the checks for the cash balances. If you have some members who are requesting cash only, and you have some that are requesting securities, well, then those members should be paying the transfer fees. So again, you need to enter them as part of each member's withdrawal. Brokers also don't like to transfer fractional shares, so you may be in a situation where you'll have to sell the fractional shares and only have the whole shares left. So just another part of the complication of transferring securities. When you're entering those final member withdrawals, you want to enter them as close together as possible. If you've got cash only withdrawals, you can enter those multiple withdrawals of cash only on the same day in My iClub. If there's securities involved, so cash plus stock withdrawal, you can only enter one per day. And again, they can be back. You can start last Tuesday and go through to next Thursday. If that's what it takes, that's fine. Just they have to be done one per day. Once they're all entered, create a final securities valuation, and then you have mostly completed the process. If again, we hear all sorts of stories about people who say, well, we've got a 3-year plan to wind down our club. I'm like, well, that's an interesting idea. But what you're going to end up doing in a plan like that is you're going to sell all your stocks now. You're going to generate gains and losses. You're going to pay out your partners. With cash perhaps, but it's just return of capital, right? Whenever you pay a withdrawal, a partial withdrawal, the money that goes out the door first is the member's own paid in plus earnings. So it's a return of capital. There's no tax ramification for the first portion of partial withdrawals that a member takes from your club. And so what you're going to end up doing is you're giving everyone their capital back. You're going to let their profits run a little longer. And then at the end of it, you're going to have a lot of capital gains and a small member payout. So the percentage of gains relative to the final payouts are going to be pretty serious. So again, seems complicated to me. But if you're going to do preliminary partial withdrawals, because you said, well, it's going to take us, it's going to take us 6 weeks or 2 months to do all these transfers, to close everything down. But we've got some cash, we've made some sales, so we're going to do some partial withdrawals right away to get the cash out to everybody. That's great. But never distribute stock in that situation. Only do cash payouts. And as I mentioned before, the treasurer often is the last person standing, and that's just to make sure they can sweep up any remaining distributions or interest payments that might come in. And if you do have withdrawals, partial withdrawals and then full withdrawals, try not to span the tax year. So only do those if you can get it done before December 31st. If you've got no securities that you're transferring, that makes it easy. You just, number one, you sell all the securities, you enter those sale transactions. Number two, you record all of the final transactions, including distributions, income, and expenses. And again, dividends are scheduled out at least a month in advance, so there's no excuse for being surprised by a dividend after the withdrawals have been paid. After the day after, all the transactions are in the books. Do a securities valuation, print the member and share the member status report on that valuation date, withdraw all the members 1 day after the last valuation date, and then you have the withdrawal distribution reports for all members. And just a reminder, besides the K1, members must have that withdrawal distribution report, especially for withdrawals, including securities. But it's a good idea to make sure they have it. You need it for your taxes, your personal tax return. You need the withdrawal report. If you are transferring shares, again, this is very confusing, and we try to figure out better ways to communicate it. But when you receive securities from your club, they're transferred to you as part of a partial or full withdrawal. If it's a full withdrawal, the basis of the lots that are transferred are adjusted according to your basis in the club. It's not the club's basis in the shares, it's the member's basis in the club that gets transferred to the value of the shares. The holding period, short-term, long-term, stays with the transferred shares, and so then the member is liable for taxes only if or when those shares are sold. Brokers may not be familiar with partnership rules according to, as the IRS looks at investment property. So the broker may issue a report that says that, or show on the report that the shares were transferred and the basis is this, and that would not be correct. It would be adjusted by the member and by the partnership based on the member's cost basis. So And the same thing goes with those securities that are transferred into the brokerage account are going to come with a basis, right? That gets transferred over from broker A to broker B, and it's not going to be correct because the basis is adjusted, but the broker doesn't know this. IRS also knows this. You can, when you complete your personal tax return, there's a form that you document changes in basis that it arise from situations like this. So if you are a treasurer and you make that transfer of securities to a member, and they come back and say, but the report that you said shows the basis is this, and my broker says the basis is much higher. Why is that? Well, this is why. It's because the basis is adjusted according to IRS rules. So again, good for treasurers to understand this, at least know that they're not doing something wrong, and the member needs to understand how, if they refer to their member withdrawal report, it will show the correct basis. If you, after you've closed out, if you get money coming in, you were surprised by a dividend, well, then you can delete all of the withdrawals and redo them, and then issue additional checks for the extra balance due to everybody. Or you could handle it as a treasurer's bonus. If the treasurer, redo one final transaction, delete the treasurer withdrawal, and re-enter it after you enter the dividend. Or you could handle it as a charitable donation, So have it come in, have it, write a check to a charity for the amount of the dividend. That's a nice thing to do as well. But just document which approach you take, and we have an FAQ that will address that. Now on the filing side, a bunch of reports: the withdrawal report, the valuation statement, income statement, transaction report for the entire year. Every member should have their individual valuation units ledger, just lists all of the investments they made in the club, and then the security transaction history, or the individual security ledger for each stock that is sold or distributed to members. You should have access to all of those reports. That's good information to keep on file during the 7 years that the IRS has to come back and audit your returns. As I mentioned, that IRS filing requirement for disbanded partnerships is the 15th day of the 3rd month. We make a final Club Tax Federal and final Club Tax State module that you use for that final short year return, because of the peculiarities of that IRS regulation that says you can't wait until the next year to file that return. The only time that would be the case is if you filed or closed in December. Then you would be able to use the January, February, March 15th. You would be able to use the next year's, you would be able to e-file in March your final return for the year. Beyond that, so that final club tax will allow you to meet that filing schedule. So you can only file that return, again, withdraw all the members, make sure the account balances are 0, perform the allocation of income and expenses for the current year, just like you do any other tax year, purchase the final club tax, federal and or state, and then generate that short year return. Just follow the prompts, just like with any other tax return. Now, one glitch or one little item here is that you won't have a Form 1099 to your broker. If you're disbanding in June, for instance, you're not, it's going to be months until later in the following year by the time you get the Form 1099. So you want to make sure that your data is accurate. If you're following our best practices principles and you're not investing in ETFs and mutual funds and REITs that require reclassification, then you're going to be pretty accurate with your final return. Follow the instructions. Use the information that my iClub reports for the basis of each sold lot. Do not check the basis not reported or no 1099 received options, because you will receive a 1099. It'll just come after you've already closed the partnership and have filed the final return in many cases. So again, this speaks to the importance of having accurate data and having streamlined, simple practices in place for your accounting and investing to make sure that this final return is accurate. You will be able to e-file that final return if you are able to use the final club tax product, and you will have K1s distribute. In all other respects, it is the same as the tax returns that you generate every year. So there's no need to wait until the next year. Just make sure all the members have their K1s, their K3s. If you need to generate those, the member withdrawal reports. And again, because you're terminating the club, your My iClub subscription will not be available next February. So you want to make sure everyone knows that they're getting their information now, and save it, put it in a safe place, right? You can save the PDFs. They can print them out, put them in a folder, but you as the treasurer and administrator of the club should be aware that there's a risk that somebody's going to come back and say, I lost it, can you send it to me again? And you won't be able to get into your My iClub account because you don't have a subscription anymore. And hopefully you save the files, but if not, then we're going to have to work with you to make that, to figure that out. State returns vary. The requirements vary for state final partnership returns. It's very similar to federal returns. See the website for some states that don't support e-filing. We have a couple of states that are adamant that partnerships must e-file, but you cannot e-file a short year final return, which is, again, nonsensical. But as you can imagine, dealing with state tax bureaucracies, we come across these kinds of illogical situations quite frequently. So we will give you some advice on how to navigate those particular products, those particular states. If you had to register with your state, or if you had to file a DBA business certificate, with a local authority, like your county or city, you may need to notify them that the partnership has been terminated. So don't forget about doing that. And then we'll talk about protecting and archiving your club's data. Even though your club is disbanded and your My iClub account is shut down, there are many reasons why that we've seen over the years that treasurers and administrators and members come back to us and say, we need our data. We need access to our club data. Well, the IRS has 7 years to initiate an audit. If you didn't file for some years, they can come back at any point. But otherwise, they can come back within 7 years and say, all right, we found a discrepancy. So document it, explain it, or pay the penalty, right? So we get inquiries from the estates of a club member who passed away, and they're trying to figure out, how do we determine the basis of this security that we got? Can you tell us what it was? Or there's a divorce proceeding, and so one of the spouses wants to know, they're doing the deep dive into the assets, and they want to know how much the spouse put into and got out of this particular partnership. Or something comes up in a recent year where last year's return, there was a mistake on the return, and so now the IRS is levying a penalty and you need to refile. There are all sorts of reasons that once your club is disbanded, you might still need to access the club website. And so our data archive and protection plan is a one-time purchase when you're disbanding that allows us to securely store your data for your club for up to 7 years. It will allow, during that 7-year window, your treasurer or administrator or other authorized club member will be able to access the club website. We'll set it up with limited one-time windows so that you can generate reports, so that you can make adjustments to data if you need to, that you can regenerate and refile your tax returns if you need to during that period of time. It doesn't provide for the full use of My iClub for your ongoing operations, but gives you that peace of mind if you need it down the road. Because the alternative is now with so many government regulations cracking down on privacy and security, is that we can't keep your club data indefinitely. So we have to wipe it from the server. And the problem is that if any of those circumstances arise, you're out of luck unless you've got a good backup, and unless the backup is still functional. We may have upgraded the club accounting engine or other aspects of the site, which would prevent your data from being imported successfully. There are all sorts of glitches and things that are not possible. Maybe your treasurer did a great job of backing up all of the data and has all the reports, but the treasurer has passed away and the family knows nothing about where to find that particular file. Maybe it's on a flash drive, a thumb stick that's somewhere, but nobody knows where it is. And so without that, you wouldn't be able to restore, you wouldn't be able to, you could sign up for my iClub again and renew the subscription, but it wouldn't help you without the data. So the current subscription price for my iClub for a year is $160 for non-Better Investing member clubs, and that's what we would charge you if you didn't have the data plan. Each time for that 1 year access, you would have to repurchase my iClub and bring your data and restore it and do the work that you needed to do. So that is the gist of how this data archive plan works. The cost of the plan is $150, which we see as if you've got a 15-member club, that's $10 per member. Over 7 years, it's $1.40 per member per year, which seems a pretty reasonable cost for the insurance that if you need it, it's there, and will protect, take good care of your data for you until then. So the club needs to, the treasurer, the administrator, other offices, keep your tax-related records for 7 years. That's the recommendation. In no case fewer than 3 years. If you did not file a 1065 in any years, keep those records forever. Keep copies of the tax returns, PDFs of your complete tax returns, keep those forever. And you can see the IRS rules for record keeping on their website. There's the link there that you can click. After your My iClub subscription expires, once your club disbands, the subscription continues until it expires. But after that happens, then within a period of time, your data will be wiped from our servers. And once that happens, there's no access to it. It's gone. It's going to be cleared out. The club, you can download all of the files in file storage using the file takeout feature, which is will give you a zip file with all of the files in file storage, and you can export a data file just like you do for backup purposes. And that data file is only useful within my iClub, but if you have the data file, you would be able to get back to your data. So here's a summary of some of the closing costs you should be aware of. The final club tax federal is $99.99. If you're a large complex club, there's the $40 deluxe upcharge. State, if you need it, is the same, $99 plus the $40 upcharge if you need it. The data archive and protection plan, $150. If you're printing and mailing returns, tax returns, that's at least $18 by our calculation per return with proof of mailing. That's acceptable to the IRS. And if you're going to postage costs for certified mail, return receipt requested, plus the costs of, there's the cost of printing tax returns if you have to print them. If you've got foreign income and you're printing a tax return and you've got Schedule K2 and Schedule K3 for all of your partners in addition to everything else, those returns can run to 400, 500 pages. So keep that in mind. And these expenses, you can figure out what these are and expense them before closing the books. That's the objective here, and that way you'll be able to write out the cash. I know this is a long webinar tonight, so I want to thank you all for tuning in. I know the team's been pretty active in the back office, so I think we've covered all of your questions at this point. I will thank you all. We'll wrap
Doug,
it up.
I
Yes,
had
Russell, go
two
ahead.
two quick things.
Okay.
Um, Number one, if you're going to be using the withdraw everyone but the treasurer and have
Yes.
just the treasurer in the club, do not let that pass over into a different tax year, because if you try to file in the new year, you only have one partner and the IRS will say that's not a partnership and will reject your return.
Aha.
The other thing is um, any gains from your investment in the club itself, uh, that's not reported on the K1. You have to look at the withdrawal report to accurately put in your personal tax returns.
Got it.
And that's it.
Great. Thank you for that clarification. As always, thank you, Russell, Sean, and Treva in the back office, and thanks to all of you for turning out to our this episode of our Investment Club webinar. We'll be looking forward to seeing you next month. And our complete schedule of webinar topics is available on My iClub. If you click the support section, there's our webinars area there that's got all of our archived webinars and our schedule for the remainder of 2025. So we'll look forward to seeing you there. Summer is arriving, so I hope you're enjoying the weather wherever you are, and we'll look forward to seeing you next time at our Investment Club webinar.